Now turning to the economy, the Federal Reserve has raised interest rates again yesterday by 0.75 of a percentage point for the third time this year. It's part of a continuing effort to slow inflation, but it could mean a recession. When times like this happen, we lean on one of few people, CBS News business analyst Jill Schlesinger. She is here to break it all down. So what does this mean for consumers?
There are always winners and losers. So let's start with the losers. Borrowers, anyone who's carrying a credit card balance. You're going to get a new auto loan. Maybe you have an adjustable rate mortgage and it's going to adjust higher. Maybe it's a small business loan. That's all going to cost you more. But on the flip side, there are winners. Savers are doing a happy dance. They are finally getting more money credited to their money market, their savings accounts, their checking accounts. And it's been a long time since we've seen that. So for consumers, it is a mixed bag.
Speaking of time, what about the timing? Why is the Fed doing this right now?
Well, inflation remains incredibly high. So we found out that we know that overall inflation rising by 8.3% from a year ago, but every single category internally rising: food, shelter, energy, and all of these things eat up so much of a household's budget.
It's true.
The Fed's got to raise rates, slow down the economy so that inflation starts to come down. And so far, it has not been successful in pushing down that inflation rate.
More increases to come?
Absolutely. In the Fed's projections, they're seeing another 1.25% before the end of the year. There are two more meetings, one in November, one in December. Additional rate hikes next year. So when we're looking forward to maybe 6-8 months from now, we're looking at the Fed funds rate at around 4.6%. It was at 0.25% just a year ago.
There's people at home that are wondering, are we headed towards a
Say it.
recession?
You say it, not me. Look, every time the Fed raises rates, the likelihood of a potential recession rises.
For sure.
Why? Because raising interest rates is a blunt instrument. It takes a while for those interest rate increases to filter through the economy. And to be clear, higher interest rates are meant to slow things down, but they can slow down too much.
Yeah.
So most economists are looking ahead and saying we'll likely be in a recession next year. Hopefully, it is a short and shallow recession.
Dollar Jill, y'all. Thank you so much.
Sure.